The bullish flag pattern is a short-term continuation pattern that occurs within an uptrend. It is characterized by a rectangular flagpole, representing the initial sharp price rise, followed by a consolidation phase forming a flag pattern. This pattern suggests a brief pause before the uptrend resumes. Now, let's dive into the secrets of this pattern. Pay attention to the flagpole slope, which should be a strong, sharp upward move. A steep and decisive rise indicates the potential for a powerful continuation. Additionally, observe the flag pattern's consolidation, which typically forms parallel trend lines, indicating a temporary pause in the uptrend. When trading the bullish flag pattern, it's essential to follow certain do's and don'ts to maximize your trading success. First, wait for a breakout above the upper trend line of the flag to confirm the pattern's validity before entering a long position. This breakout acts as a signal for potential bullish continuation. Set a stop-loss order below the lower trend line of the flag to manage risk and protect your position. This ensures that if the price reverses and invalidates the pattern, your potential losses are limited. Being patient is key. Avoid entering trades prematurely before the breakout, as it increases the risk of false signals. Patience and confirmation are vital in trading this pattern. Furthermore, don't ignore the overall market trend. Trading with the prevailing trend enhances the pattern's accuracy and increases the likelihood of a successful trade. A bullish flag pattern within an overall bullish market environment tends to be more reliable. To trade the bullish flag pattern effectively, look for a breakout above the upper trend line. Once the breakout occurs, consider entering a long position with a target price projection. Measure the height of the flagpole and add it to the breakout point to estimate a potential target. This projection provides a general idea of the price level the uptrend may reach. To enhance the accuracy of trading this pattern, consider additional factors. Look for supporting signals such as bullish candlestick patterns, which can provide confirmation of a potential breakout. Additionally, watch for bullish divergence in momentum indicators, where the price shows a higher high while the indicator shows a lower high. Positive news catalysts can also strengthen the pattern's bullish bias and increase the probability of a successful trade. Remember, practice is crucial to master the bullish flag pattern. Analyze historical charts, study real-time examples, and refine your trading strategy. Stay disciplined, manage your risk effectively, and constantly evaluate your trades to improve your trading skills. That concludes our discussion on the bullish flag chart pattern. If you found this information helpful, please like this video and subscribe to our channel for more captivating content. We're going to uncover the secrets of the cup and handle chart pattern, a powerful bullish continuation pattern that can help us identify potential profitable trades. So, let's dive in. The cup and handle pattern is visually distinctive and easy to identify. It consists of two parts: a rounded cup shape followed by a smaller handle formation. The cup represents a temporary pullback in price, followed by the handle indicating a consolidation phase before an upward continuation. Now, let's explore the secrets of this pattern. Look for a smooth, rounded bottom in the cup formation. The cup should have a U shape, indicating a gradual recovery from the previous downtrend. Avoid cups that are too shallow or V-shaped, as they may lack the required depth for a reliable pattern. The handle should ideally be small and downward sloping, indicating decreased selling pressure. When trading the cup and handle pattern, it's crucial to follow certain do's and don'ts to maximize your chances of success. Do look for an increase in volume during the cup formation, indicating accumulation by buyers. This volume surge confirms the pattern's validity. Confirm the pattern with a breakout above the handle's resistance line before entering a long position. Set a stop-loss order below the handle's support level to manage risk. This level acts as a safety net in case the price reverses and invalidates the pattern. Don't enter a trade too early, before the breakout occurs, as it increases the risk of a false signal. Also, avoid entering trades when the overall market sentiment is negative, as it can impact the pattern's accuracy. To effectively trade the cup and handle pattern, wait for a breakout above the handle's resistance line. This breakout confirms the pattern's validity and provides a potential entry point. Consider placing a target price by measuring the cup's depth and projecting it upward from the breakout level. This estimation helps identify a potential price target. To enhance the accuracy of trading this pattern, look for additional confirming signals. Pay attention to bullish candlestick patterns that occur near the breakout level, as they strengthen the bullish bias. Additionally, consider using momentum indicators to identify bullish divergence, where the price forms higher lows while the indicator shows lower lows. Combining these signals with the cup and handle pattern can increase the reliability of your trades. Remember, practice is key to mastering this pattern. Analyze historical charts and study real-time examples to gain familiarity. Be patient, wait for strong confirmation, and practice proper risk management to minimize potential losses. If you found this information valuable, please like this video and subscribe to our channel for more engaging content.